Hello. Good
Hello,
evening, everyone.
hello everybody. Welcome to Mara and Friends webinar series. My name is Aleksandra and I'm your today host. We have Alex and Sasha today here with us. This is our episode 4, Building Lean, Lessons from Solo GP and a Solo Entrepreneur. A little bit of background. So we know that early stage startups raising under 10 million are increasingly overlooked by large venture funds, and that gap has created space for a new model, the Solo GP. So today, in this conversational webinar, we will explore how solo general partners are building fast, lean funds designed to serve founders earlier, move quicker, and win deals through relationships rather than heavy processes. I will just do a bit of introduction of our panelists. So today we have Alexander Bartolini, who is a private credit professional and Bootstrap Europe's first alumni, with a track record exceeding 1.6 billion across multiple jurisdictions and stages. He is now launching GPI, Europe's first solo GP growth lender dedicated to the underserved lower mid-market. And we have Sasha Batica, who is the founder and chief executive officer of Mara, a leading solution provider for structuring private market investments. Founded in 2021, Mara equips founders, wealth managers, family offices, and private investors with technology-driven tools to establish and manage special purpose vehicle SPVs, streamline fundraising processes, and maintain compliance across all jurisdictions. So thank you very much for joining this panel discussion. And I would like to also say to all our attendees that there is a Q&A and that all of you can write any questions you have during the conversation. And then later on, we will be able to reply. So first things first, I would like to start this convo with asking Alexander a question. So what made you decide to become a solo GP and why did you choose this path?
Oh, Alex, I think he's still backstage, so I messaged him to try and come in. So we're just waiting for it. See if he comes.
Okay. Hello.
Here you are. He's here. Great.
Great to have you here. I just asked you the question so you can immediately start answering.
Yes. Yeah. Thank you for the introduction, Alexandra. Good to see you, Sasha, again. So the question. So just to give a bit of context, right? So the solo GP model, so we've seen this every time more these days, but I think it's something that has existed for actually a long time. We used to call them like super angels, like in a pre-seed seed equity space. What happened is that the cost of launching a fund actually has come down dramatically with a lot of like out of the box solutions that came to the market. So it became just more easy, like to launch a small fund. I think now a solo GP can perform tasks that used to require an entire back office team. So that's just the reason why I think it's a popular topic today. And yeah, and to your question, I think so. The reason why I decided to go down that path is for a mix of different, like maybe personal, strategic, and economic reasons. On the personal side, I think if you are considering launching a solo GP platform, first thing you need to ask yourself is if you are comfortable owning or distributing the risk, because you are the sole decision maker here. You are fully accountable. So you need to be comfortable with that setting. The good thing is, like you won't have any issue with track record attribution because it would be fully yours. And you need to be comfortable with a more, like a conviction-based investment style, if you like. Like you won't have to make compromises with, like other partners. You won't be competing with another partner investment thesis. And something also, that I realized when I started this is, like the fund, the solo GP fund will be actually an expression of my own personal brand. I think it's very important. It's the expression of yourself. So this is not, like it's not for everyone. So I think, those are the first consideration you have to do on a personal level. On the economic side, of course, like you will share the carry with a small team, but with no other partners. So, if I'm thinking about, like the senior investment professional that are today working in an established player, if they believe they have, like their individual track record carry LP credibility, it can be very attractive, to launch your own shop and get most of the carry for yourself. Um, so and yes, and also in terms of vision, the first thing you need to clarify is whether your intention is to build, like to repeat a series of small size funds, so, sort of with the same characteristic and the same setup, or is your intention, like to start as a solo GP and then evolve as a multi-partner funds to scale the platform, to scale in size. And that's very important because it will impact, like the type of external fund admin you're gonna take on board or your hiring process. So yeah, so those are the very first consideration, that I had when I started my journey.
Thank you. Thank you for sharing that. I remember you mentioned about a clear gap in the market for startups raising under 1 to 3 million. And what do you think changed in the venture landscape to create this opportunity?
So I think, so yes, there is a gaps. There are some gaps. I think it also depends on the asset class.
Hmm.
Like if you like in my, in venture debt, for example, like the usual suspect funds, they all move up markets. They become larger. They write, like larger checks, and it doesn't become very viable or economically, it's not very worth the time to do some small checks. So there is a dislocation in the market, a natural dislocation that has created, space, like a white space for small funds to do to write small checks at a pan-European level. Now, if we take equity, I think it's the opposite. In equity, so we are seeing actually larger funds moving down market because you have a
Hmm.
lot of competition, between Series A and Series B. So some we've seen this, huh? So some of the large funds coming down to do a small check than usual to secure their ownership and a position in a startup that is growing fast and where they see, like a lots of potential to deploy capital. So, but the problem with this is that, like the smaller rounds, like the 1 to 2, the 1 million round at pre-seed seed is now, becoming, I think the norm is now, to raise a 2 to 3 million round. And that means that it reflects every time more the process of an early Series A round in terms of pricing, valuation, and process. So what it means is that those rounds take longer, and that can be quite exhaustive for founders that want to get quicker to market. Some very great funders might not even need that much capital at the beginning. So they would rather get less capital but get the round closed more quickly. So I think, just all to say that in this space in equity, I think like if you are solo GP and you can move fast in your small fund, that can turn into your advantage.
Mm, nice. And why are larger funds like structurally unable or unwilling to pursue these smaller early stage deals?
Well, so again, for a couple of reasons, right? So I think, like for economic and structural reasons, the way they are set up. So if we take about, like if we talk about the economics, you know, um, let's say, you're a 100 million fund and you're considering doing a 1 million investment, so it's quite small, right? Even if the outcome of that investment is a very strong one, it's going to be very hard to be quite meaningful at fund level.
Mhm.
So, and you think when you think about like the partners compensation, it's tied up to, like DPI, TVPI, fund, returns at fund level. So, it means it won't be worth that time, like personally to pursue a very small deal. So The other thing is, when you're a large fund, you are looking to put, like more dollars at work to work, but also for ownership. And usually, at that stage, you're looking for 10, 20% of ownership. So at pre-seed seed, again, like if you if you are looking for 10, 20% ownership for a very small check, it won't seem as very funder friendly. So it won't work for the funder either. And worse than that, if you actually do something like this, you might jeopardize the chance of that startup to raise more capital later because you will have to make space for other big investors to come in. If it's a startup that plans to raise like more capital in the future. So yeah, so I think you know, economically for large funds, it won't make sense either for the funder or for the fund. And the other thing is, like a large fund would probably run, like a multi-level IC, like a different stages of ICs. So, the cost of running the diligence and even the governance, like the monitoring of this small investment is higher than it would be for a solo GP. So, it's just that the structure again is not optimized for large funds to do, like very small checks.
Mhm. And what makes the solo GP model practically well suited for this segment compared to traditional like multi-partner funds?
So like if I'm thinking about like equity again, in this asset class, these rounds, the 1 to 3 million rounds, they are, funder led and time sensitive. So at that stage, like founders come to you and they sell a vision, they sell their judgment, their capabilities, and a market opportunity. So, there isn't much data to crunch. So the diligence is not the same, and speed in this type of round it's a decisive factor because and more than price and valuation, I would say. So if you are a slow GP, you run a small fund. A small check will be economically viable to you. It will be meaningful enough for the G for like for the founder. You don't need to cover large overheads at your fund, and you can move faster. So that's the reason why solo GP running small size funds are well suited to do the small rounds.
And what do you think? How does speed and direct founder engagement become a competitive advantage at this stage?
So it's a bit, like what we just said, right? So like funders, when they raise a small, like at the early stages, when they raise a small round, they want to optimize for, for momentum, certainty, over price and over check size even. But this is the what is important is to get the round done as quickly as possible. Because for these small companies, the market is still forming a view on you. You know, you're not up and running really. So the windows of opportunity for that round to close is actually quite short. And if the round drags for too long, when you don't have so much data to crunch, that can kill a deal quite early. So the founders have a very strong incentive to just get the deal done.
I think maybe Sasha would have something to say regarding this question as a founder.
Yeah, look, I think I'm a solo founder as well, and yeah, I share a lot of the same thoughts. I think as Alex. Partly when you work for yourself, you only have like one person to answer to, so it does help in that decision making. Critics will say that okay, well you need to bounce ideas off people. You might need a board or like a proper investment committee to really test like decisions. But personally, I've got advisors. Some are paid, some are investors, or some are informal. More like a mentorship, so that you can always build people around you who are not in that GP partnership to counterbalance. And I think there's a level of maturity which every founder should have, where you need to seek out those opinions to test and validate yourself. But I think that key point for me, it's about just being able to make clear decisions, quickly and fast. Probably, the one thing which I'm always mindful of is you're kind of I'm doing a lot. You're wearing a lot of different hats as a solo founder, whereas other businesses, which I know they may have two or three founders, those roles are sort of delineated. But when you're a solo founder, you have to be like the CFO, COO. You got to be like the main salesperson, and there's a degree where you can delegate that and hire some people, but that final decision making does need to come from you. And it's probably the same for you, Alex, right? You're fundraising. You're also you're looking after like the firm accounts, and you've got to source deals as well. It is quite a lot. That's probably like one of the counterbalances to that.
I relate a lot to this point, and I think, like going back to Alexandra's question on speed, I think, like as a solo GP, if you can make a fast decision, like again, like you will reduce the founders' fatigue because it's exhausting to do
Mm,
fundraising. And as you said, Sasha, you're the chief product officer, you're the chief financial officer, you're the fundraiser, you're doing everything, at the beginning. So, if we can actually, like make sure that, the due diligence is not, like heavy and quick and clear, I think, founders will remember the first one that moved.
yeah, definitely. And then there's also I think I was thinking about this recently. Like people, when I'm like selling, I think just being the founder, like it makes people just listen a bit more, and they kind of enjoy talking when I'm sort of pitching the solution. They enjoy just the fact that it's coming from the founder, someone who's put all the energy into building that thing, rather than like a hired salesman. There's almost like more emotion that comes across probably when I'm selling a bit more, and it's probably the same for you when you're trying to like win a deal as well. I can imagine that they'd much rather deal with you because it's your skin in the game ultimately, which is far more than maybe like a traditional bank, for example, which they may be looking at instead.
Yeah, indeed. So I think, like if you're a founder and you're looking to onboard investors where you have sort of a personal touch, someone that can be agile.
Mm,
If you're a solo GP, you're not gonna hide behind a process. You're gonna be fully accountable to the decision you make. You are the sole decision maker. You're not a solo team, huh? But you are the main decision maker.
mm.
You will provide direct feedback straight on, right?
Yeah,
Um,
yeah. And that's something I guess we have because we're, working together on the structure side. And it's really just like one founder to founder, I guess, just working things out in real time as opposed to going through different, other channels and review stages. That's something which, we work with much larger funds, for example, and the decision making is just slower, like because of that.
Yeah, I would also agree because the relationship is what drives, I think, a good business and good relationship is really important even in fundraising. So I will also ask now a question to Alex, like, can you explain how that changes diligence and decision making?
well, so
Small
yeah.
equity deals, we spoke, they're fundamentally relationship driven. So how it's a change maker?
Yeah. So I think, well, both for equity and debt, and you need to have a very clear process. So that starts with having like a very well-defined framework where you have clear investment guideline, for the whole team. It could be around the type of profile of funders you're looking for if you're an equity fund. For me, it would be about, like some, the business sanity, if you like, like what kind of, around, like some financial metrics. I would have, like very hardcore metrics to hit. You need to run, of course, a stages approach. So, to be very quick to select the deals where you will focus the most. So, everybody runs their own initial checks. So I guess on the equity side, you will be running the first reference calls on the founder or the clients if you have some traction. For me, it will be like initial checks on some financial metrics in the debt on the debt side. I think like whether you're doing debt or equity, you develop your own like pattern recognition system or radar. And like so we all have our common red flags. For me, for example, it would be like if I see a messy cap table, if I feel there is a flaky communication with the founder. When we talk about relationship, I believe that the relationships I my first covenant, you know, because in the early stage you need to act very fast before even an issue arise or if it just start arising. So the outcome will be very different if you have that communication and I have the ability to actually act quickly. If I see light reporting, like not much financial discipline for me, it will be a red flag. I'm not going to spend much time in this business. So I think so that's about the process. Now, on a personal level, as an investor, what I tend to do, and that's it's just personal, but at the end of every year, I document all the key decisions that I take as an investor, and then I reflect back on the main ones, like the most exciting deals that decided to to turn down, the one that I approved, and like with the new information, seeing how it has performed, I try to reflect and see if those were the right decisions at the time. Like, or if I had to change my criteria or make it a bit richer. So again, it's to recalibrate your pattern recognition system. I think it's a good practice as an investor. You need to do this from the early days, right? And in terms of diligence, like we still go deep, when we go to the next stage, but we just don't go wide. Like we focus again on what is the most important. So in depth, like I will skip over modeling projections, like decorative KPIs, or like committee friendly narratives, like these kind of things. Like I would really focus on the key metrics that matters to me, because I think it's actually even more dangerous to have like a false precision, trying to be overly precise, than having like an imperfect judgment. So that's, I think, and that's true also for equity. So in venture debt, in my case, I believe it's better actually to have like a full accountable deal captain that is doing the deal, underwriting the deal, than five unaccountable ones in a very large bank. And the banks, more than the funds, the banks are often encounter that problem. So yeah, in depth, I think that's what I would say. Like we 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 tend to spend maybe it will take 30 minutes to perhaps to pass on the first stage of the process.
Hmm. And how large does a fund need to be to operate as a solo GP in equity compared with debt?
Well, so I think that depends on the asset class. Yes, indeed, and the check size. So if you take equity,
Hmm.
like a 50 million fund, like with the 50 million funds, you can write perhaps like a 500K check on average. That gives you like a 20, 30 company. You keep also another 500K for each of the top 10 or top 15 of your portfolio. So, with the 50 million fund, that means that you can make meaningful checks, at these smaller rounds for the founders. So it's founder aligned. And it's also, and you can achieve diversification, portfolio diversification. So, you know, on a 50 million fund, it's a 2% management fees, what, 100K of management fee. It's enough to cover your fund expense, a small team. You may have a surplus to spend on, deal flow initiatives. So economically, I think it works well. It's meaningful for, like for the founders. So 50 million is probably what I will say is the right size, for an equity fund. If we talk about a venture debt fund, I think you actually need to make this twice as large for 30 million, because like you would need to write larger checks to be meaningful for these companies that are looking for financing. So like a 2 million check on average on 30 million portfolio, we're talking about 50, like a portfolio of 50 companies. So in depth, you don't need to achieve as much diversification than in equity. And actually, it's the opposite, because if you have too much diversification, you lose control over your portfolio. So in equity, you would want more diversification, because if you think about the distribution of returns, You know, like in equity, it's wide. You have a lot of zeros, a few that returns between 1 and 3 x's, and you have a couple of outliers, and hopefully those are fun returners. You know, so you are chasing for the moon, and it's power law driven because it's very dispersed. So, you know, you need to play that game. You need to be very diversified. If we're talking about depth, you know, I want visibility on my returns. You know, I'm not chasing for the moon, you know, like a moonshot. I'm backing proven models. I want, you know, like predictable returns. So my portfolio, my distribution of returns should look like, you know, like a maybe 90% will return between 1 and 2x. 5% will be, you know, like very positive outliers, and 5% will be, unfortunately, maybe, you know, like some losses. So, you know, we don't want to achieve the same, we're not building the same portfolio. We don't achieve the same, you know, diversification, and we need to write different checks. So that's the reason why I think the minimum fund size is different for an equity fund or for a debt fund, whether, you know, even if we are talking about early stage investing.
Thank you, Alex. One more question for you. How does being lean actually improve fund economics for a solo GP?
Well, so by being lean, I think as a sort of GP, at least, you know, that's personal experience. I think, you know, like um, you are more focused on you know, you're more careful with spending. So you try to cover just really what is essential, you know, and that I think, I mean, this is not a consideration that I had when I was working in a large fund. It's not, and it's not what I felt from the partners either. So. I think other results, you may end up with less overheads in proportion to the fund. So for, you know, like so I think, you know, for the LP, the investors, it means that more of the fund performance flow, you know, like to the LPs and into the carry. So I think, you know, like it's not hidden by overheads so much. So what it means for investors is that being lean, you know, so eventually more dollars are, you know, like, you know, working in the fund rather than being, you know, like crunched by overheads or OpEx. So yeah, I think that's the reason why I think it would be, you know, more attractive from an economic perspective for an investor.
Nice, nice. Thank you very much for sharing this. And I will turn now to Sasha. Sasha, I know that you briefly mentioned this, but from your founder operator perspective, like what stands out when working with solo GP versus with a larger fund?
Yeah. So we've got clients from both categories. I think for me, there's just a lot more hunger working with the solo GP, solo deal sponsors for sure. Because it's really just them, you know, they're really, you know, trying to build their personal track record, personal brand. So yeah, I think the hunger really comes across. So yeah, I think working with larger funds, you know, there's just more bureaucracy, I think, with their internal dealings. Things are just a bit more cautious, careful. You know, I think that will attract some investors, but you know, other investors will certainly be more attracted to that hunger which solo GPs have. I mean, we see that from a service provider perspective. You know, even when we're, you know, structuring the deals, they're quicker to respond. You know, they see just things which, you know, maybe other like larger funds, they're thinking about the deal from a more impactful angle, I would say. I mean, it's not just like going through a process. That's the sense I get from solo GPs rather than larger funds. I think, you know, just thinking back from my career, I've worked for larger organizations, small ones as well. Cambridge Associates was an investment consultancy, which I was part of, working in the manager research team. They had a specific focus looking at, you know, emerging, you know, solo GPs, which was quite interesting. I think they highlighted that, you know, that hunger point as well. You know, skin in the game, that desire to really, you know, prove something. I think probably the one like counter is that, you know, there is slightly more, you know, risk with you know, smaller funds. That's just it. But you know, it's quite interesting. I would say there is risk with the team, but with solo GPs, you don't have that team risk. And it's the same with me. Like I don't really I'm a solo founder. I don't have a co-founder that I could fall out with because ultimately it's just me in control of the business. And you know, there's a lot of statistics for emerging manager collapses and also, you know, just business collapses. The number one there is just the team falls apart. So that's something I notice as well. I think that some would critique that lack of team, but I think I see it as an advantage from that perspective. But generally, I think dealing from solo GPs to large fund, I would just highlight that hunger. I've said it already before, but just highlighting that, and then just that speed of execution, speed of decision making, particularly when we're onboarding them. We see that a lot more from the larger funds.
And how important do you think speed and clarity is for founders at the earliest stages?
I can relate to that. Can take this look. So well, I think speed and clarity, is just a lot more important than the check size or the price you expect, for your company. Because the thing is, again, the window of opportunities is super short. That's what we're telling before. If you're a solo GP and you can move fast, a very quick yes can actually, pull the others into the run and get it done. So solo GP, I would say, have this power, to give that first signal that will, that will unlock the whole process. So, and also, like Sasha, we talked about that earlier as well. It will reduce, the fatigue of just dealing with a large team running a long process. So I think that's why I think speed at an early stage is paramount, whether it's in equity or debt.
And do you see parallels between building a company solo and running a fund as a solo GP?
Well, as a solo founder, solo GP, I think we are both fully accountable. So,
Mhm.
so the founder owns the product. Me as a solo GP, I own my investment thesis. We both have like limited resources, so we focus on what really matters the most. Um, and speed again, we talk about that, but like I'm sure a solo founder, like can iterate more quickly its product. Me as a solo GP, I can more quickly take decision on a deal and execute. And we are both building our own personal brand. So the company will embody the founder vision, and like the fund will embodies like the solo GP investment thesis. So there are lots of similarities.
Yeah, definitely it is. And what advice would you give to founders choosing between a large institutional investor and a lean partner-led GP?
Well, I think if you again, if you want like a responsive investor, someone that pick up the phone in depth, for example. You would want you want a very responsive lender. Like if the person that is selling you the loan cannot change the terms,
Mhm.
I think that would be a big issue, and you should walk away. So I think in depth it's even more important. I think then, of course, some funders will really value having that direct line of communication with the decision maker. As a solo GP, it speaks by itself, right? It will be yourself all the time. And if you are at the stage where time is critical, like, then solo GP can add lots of value into the round.
Um, yeah, and now I want to just turn back to risk mentioned earlier. Like LP often worry about that key person risk and with solo GPs especially. So how are you thinking about mitigating that risk?
I think in general, the market is mispricing, like speed, trust, and ownership. That brings, like a solo GP. So, like I think there is a misconception first about solo GP, the solo GP, because I heard a lot of time, like LP saying, in early stage, we want to back, like it's a sports team. We want to back teams, not individuals.
Mhm.
And the thing is, very often behind a solo GP, there is a team. So you're actually backing a team. So there's a misconception here that I'm fighting, quite often. The other thing is that is not taken into account is that the institutional infrastructure, no longer require multiple partners, because again, like you can choose like top-notch external fund providers, that that can run a top tier like compliance and fund admin and investor reporting for you. I think a solo GP can also leverage technology to punch like above its weight by leveraging like like very intelligent AI driven like a CRM tools like for deal flow sourcing. This used to require multiple people to do that properly. So, um, so I think yes, there are these misconceptions. Solo GP also means like more concentrated risk, but also more concentrated control.
Control. Yeah.
And I don't think LPs are like scared of risk. I think they are scared of unpriced risk. So, but what I mean by this is that, and in this case for solo GP, you can mitigate this by hiring like a senior principal or senior director, or call it what you want, but someone that can execute a deal, source a deal, execute a deal, and support funders while you are temporarily unavailable. That's the most important thing. So because when LP like met that critic, they are actually scared of like business continuity. I think hiring a senior principal can alleviate a lot of these concerns. I think a good practice also is like to provide like comprehensive quarterly reports to LPs. And it's a
Hmm.
common mistake that we do as solo GP. We don't communicate as often as we should with our LPs. So, because if you think about this, like if you, provide those comprehensive quarterly reports, standardized reports, I think it will eliminate a lot of, LP anxiety. If you receive consistent, like comprehensive information on a regular basis, like you will be your impulse to ask for a quarterly catch up, or
Hmm.
I think will come down dramatically.
And why do you think is hiring as like a senior team member or principal such an important single signal to LPs?
Well, I think like it shows you that first you have more bandwidth to run like process end to end. Um, Second, it shows you that you have someone that can still run the show if I'm not available, or if I'm dragged into a very like a time-consuming process. Um, and um, and also, I think more importantly, if your intention is to scale, the business to a multi-partner platform, it shows to LP that you are building this fund to scale, because this senior principal will eventually transition into a partner role for into the next fund. So it shows you signs of early signs of scalability.
And how do you practically manage like that fundraising after first close while staying focused on basically portfolio execution?
I think it's actually the most challenging part. Like for a solo GP, it's not to get started. It's at first close. So there's a common mistake that we do. I think is that we mistaken the first close for the finish line, and it's just a milestone. And it's a difficult time because you have indeed to continue fundraising, but you have to deploy capital. You have to execute deals, and you have to start, like supporting your first funders. So this require balancing between fundraising and the fund, like and deploying, like with a lot of agility, and it requires you to have, to be very disciplined and have, good systems in place. So, like for example, like I have my own metrics to hit, like on a weekly basis. I will have my own metrics in terms of how many funders do I want to talk per week, how many LP conversation, with new LPs or potential LPs or current LPs would I want, in a week time, but you need to be very, very disciplined about these things, because you need to run both at the same time.
Yeah, exactly. And Sasha, I would have a question for you from that operational standpoint. What do you think tends to break first if these processes aren't clearly split?
I'm trying to think how best to answer that. Probably I would answer a little bit different. I'd say like trust, I think, which is really, essential. If you don't have like clear processes, then your stakeholders, your customers, I think will just lose confidence instantly. And it's very easy to then blame like you as, oh, it's just you, or just you as a founder. If you had like a more robust team process, that will all come there. So I think it's absolutely essential. Trust, is very easy to, lose, and it takes long to kind of like rebuild it back. But then there's also just like more of the commercial aspects as well. If you don't really have the clear process, you can't really execute. So in our case, that'd be launching SPVs effectively for clients, and Alex's case, that's really getting the debt to customers in a really clear, effective way.
Thank you, Sasha. I would have a question actually for Alex. Is the solo GP model scalable?
Well, I think it's reputable. And
Okay.
again, like it depends on the vision and the strategy, right? So, like in my case, beyond like 30 to 50 million debt fund, you need to have you need to have two very strong principal or another partner coming on board. Because there is a limit to how many board seats you can take in a year. There is limits into how many deals you can do per year. It's not healthy pretending, aiming to do more than 4 or 5 deals per every senior person. So, again, a 30 million fund is 50 company. An investment period of 4 years, you want some margin, means, 4 or 5 deals a year. We're already talking about, I mean, 1 person and a half, like a
Mhm.
senior person. So if you like extend this to 50 million, like you're already overstretched. Otherwise, like if you have pressure to deploy, and too much pressure to deploy, you will sacrifice the diligence, and of course, you can't afford that in debt. So there is a cap at 50 million, I think, and it will go a bit under that. And in equity, it will depend on the strategy, I think, but um, you know, in pre-seed seed, again, beyond 20 million, you should look for another partner. If it's a Series A fund, you know, uh, maybe around 30, 40 million, it's the same story. You need to scale that and find someone
Mhm.
else.
And what types of LPs are best suited for solo GP funds?
Well, so we talk a lot about like a personal relationship,
Mhm.
personal touch. Sasha mentioned a lot trust as well. So this is very relationship driven business. So I think at that stage, it relates a lot to family offices. I think it's
Mhm.
it's fundamental for them. So it's less transactional with family offices. That's what I mean. So that's why I think it's a good public like to address. Um, and perhaps also, like since you don't have so much overheads, if you are starting to bring in too many institutions, first you will have to to pass a filter, but also they may have their own reporting requirements. So it becomes very hard to deal with each of them. Um, so I think on the institutional side, more for the equity, you will see a few fund of funds, particularly in the US, but some in Europe as well, that focus specifically on micro funds, emerging managers, or solo GPs. It's part of their thesis because they are aware that, like these funds generally, the studies, and Sasha, you can relate to that from your work at Cambridge Associate, but a lot of these funds actually generate higher returns, high symmetric returns. So if they focus on a niche, and these small fund of funds, like they understand that potential, and there could be also very more like a very very nice LP to talk to if you're raising a solo GP equity fund.
Mhm. Nice. Thank you, Alex. I would have one more question for you, and then we can switch to public questions. So, What mistakes do first-time solo GPs often make?
Well, so there's one I mentioned just before, right? So like, do you do not communicate enough with your LPs? So I think it's a
Mhm.
very common mistake. Second one is probably, like trying to do too much without support. You have to realize that you will need a team, you will need external advisors early on. So, so you need some senior members, you need some senior advisors, and you need a very robust, external fund admin with platform service. Um, Ignoring the fund economics. So we talk about that, like setting a fund that is just maybe too small relative to the fees or to the checks, that you need to make to be relevant to your market. Um, Overexpose yourself to a single deal. Like when you're up and running after first close, there's a temptation to do, quick deployment, and I've seen some solo GP making the mistakes of, betting, like just writing two large checks
Mhm.
in one single company. So again, it's critical to have, like a very clear guidelines and framework to avoid those mistakes. Um, yeah, and I think also underestimating that, the fund, the fund brand is tied to your personal brand. So, like as a solo GP, fundraising is less transactional and more relationship driven. So, you will have to do a lot more with who you are.
Nice, nice. Thank you very much, Alex. I will now go to the questions. I don't know, maybe Sasha would like to answer from some of them, although I think they're mostly for Alex, but maybe you can read it out and
Okay, let me take a look. So what I think the first question here is just talking about the difficulty of raising funds. So that's raising capital from investors. So the question is, as a solo GP, Alex, what is the advantage? How easy or difficult is it for LPs to trust solo GPs?
So I think so, yeah. So the good thing about being solo GP, again, like if you have a targeted approach to fundraising, everybody needs this, right? In my case, it's family offices, right? I have already also, I started this journey with, already knowing a small network of, of investors. So, um, since it's relationship driven and it's trust driven, it's something that you have already built before launching your own journey. I think that can turn to be an advantage. The bad thing is you won't fit the box to, the typical fund of funds or the institutional investors. You might be too small. A lot of them would want to see already like a track records from your own shop. So they will need to see a fund two, or maybe they will come in at fund three. So it just exclude naturally, like it reduces the universe of people you can talk to. But like these families, once you gain the trust, and very often is like doing some like talking to them regularly, showing them deals, that can move the needle very quickly because they're also fast decision maker when they want.
Okay, got it. And there's a follow-up to that from the same person. It says, secondly, once you've launched your fund and raised your first fund, what is the usual trajectory of solo fund founders? Do they go for larger funds after that, or does it get easier to raise capital from investors for like the second and third fund?
Well, so I think so. You an early stage funder, like like you raise the first fund on a vision, on a strategy, on the back of, like, and people trust you as a team, as an individual. So that's how start fund, you start fund one. Fund two will be about showing, like discipline in your investment strategy. And I think from Fund 3, it's entirely on performance shown in Fund 1 and Fund 2. In the case of venture debt, like you might have already actually, you will have been through, very likely actually one or two workouts. You will be able to show what happened when problems, materializes. What is your ability to fix it? So, and then I think that scale naturally. So the first one is really about um, your story, your vision, the market opportunity, and then it's every time more performance that speaks by itself. Now, if you ask me, I think most of the solo GP that starts have an ambition to scale it to a multi-partner platform at some point. And in my personal case, I'm starting with a 30 million fund. My end goal is to get to 1 billion under management within 10 years, because that's you can double. Every 3 or 4 years you raise a new fund, you double up in size if you've done a good job, and you can get there very quickly, even if you start very small today.
Got it. Thanks. There was a second question. It was mostly, I think we've answered this already, but I'll read it out anyway. It's from Carolina. For the first solo fund, where do you raise capital from? Family offices or institutional investors? Considering it might be a small 5 million fund. I think you talked about how you're targeting family offices, right? But is there any scope for institutional investors from the conversations you're having?
Some asset manager like Agile, that have a strategic allocation to private credit in my case. So like are part of the discussions that I'm having now. So I would say just family office is just the bulk of what I think is relevant to my strategy and to my fund. But like if you are raising an equity fund, I think you have access to a lot more of public source of funding. You have a lot of like fund of funds that are comfortable coming in, like in fund one, in a small fund, in a micro fund. So you have I think if you're raising equity, you just have more. It's more institutionalized because venture debt is a niche product. It doesn't fit all the boxes of private credit, and it doesn't fit all the boxes of venture capital because it's a bridge between the two. So in my case, I think is a bit unique because I'm across two asset classes.
Got it. I think just from what I see in the market, there are certain fund funds which look at solo GPs and emerging managers. So, that I would class that as an institutional investor. And then also what we see from solo GPs specifically is actually just raising from their network. So crowdfunding from friends and family, high net worth investors. I think that's often what I see.
Other
I
GPs,
see,
other GPs themselves.
yeah, solo GPs. Yeah, I see a lot of them kind of like quote unquote hustling on LinkedIn, and I won't name any names, but I think a lot of them have had success with really pushing that personal brand, leveraging their personal networks, and if you aggregate if maybe 50, 100K checks, you can get to, 2 to 5 million quite easily. And it does often, compound as well. The more investors you get in, that's what we've seen.
If we look at the US, like there are a lot of institutional investors that are specifically focused on taking GP stakes. So basically, so they will onboard you on their platform. They will provide you, like lots of supports. They will provide the first checks, that will put other in and signal to the market, like we're an institutional investors. We're backing this team. We're backing this solo GP. And but you will have to share the economics with them. But that can get you up and running quite quickly. It's big. We're already in the US. We're talking about this GP stake business as a separate asset class. So
Mm,
I think in Europe we are far behind that. It does exist. You have a few funds that are doing this in a large scale, also in private equity, a bit less in venture capital. But I think it's definitely a trend. So like it's I think it's another part of institutional money that you can tap in.
mhm.
And if you can't really raise a fund, there are also others alternatives. You can actually grow yourself as an independent sponsor. This is something also that we're seeing a lot. Like managers that are, like they're closing a mandate with a segregated mandate with an institutional investor. The institutional investor will have its own committee, so you don't have full control on the investment, but you have an ability to actually deploy capital. You avoid fundraising, and you build track record right away. You get started. So then that can be a catalyst to your fundraising later because it will be like a fully attributable track record. So there are other ways to go if fundraising is just it takes too long. Um, and I think I've seen that a lot in the last 2 years.
Hmm. Yeah, the GP stakes is interesting. We're seeing big activity there, but I would sort of argue, is that really a solo GP if they give the stake away to because they become part of the GP,
So
almost
yes,
like a
but
middle partner
again,
as
so
well.
that is a very like complete separate conversation because
Yeah.
if they have part of the economics, I
Hmm.
would not recommend you to give away your control over your decisions. You should remain fully independent in the decision you take. They may
Hmm.
have like a what we call a shit, like a oh shit clause where they can say, hey, if you're doing something very stupid, I might stop you there. Like if you invest in a sector that is, I don't know, like a cannabis or whatever, something that is a bit uncomfortable for them, then they might have a veto, but you should try, like to be fully accountable for your decision, and you should try not, like to own it, not lose control. So they can have a stake, but they should not control the IC, in my opinion.
Yeah, got it. Another question here: who does the finance fund admin, i.e., non-fundraising related activities with a solo GP? Which is quite interesting because I think some of the emerging managers I see, you've usually got one investment partner, you've got one fundraising, and then you've got the ops COO sort of partner. But yeah, who does it for you?
Well, again, I think you have some external platforms that are very well suited, so you can actually do it on your own without, taking out too much of your time. I think when you start having like two portfolios, that's when it starts to be a bit more tricky. You have different, you have, a lot more work to do. I think that's when you start thinking about bringing in a CEO or portfolio manager that will maybe transition into a financial manager or you also have some external CFO service for fund managers. So, there are a couple of ways you can tackle that. I think it will depend on the fund size again, how much time you need to free up for fundraising and so on. But, there are some platforms that are doing very efficiently, and you can handle it, on your own, with this administrator at the beginning,
Got it.
without
Okay,
doubt.
well, thanks. One more question. This is from Luba. What is your view on VC micro funds under 10 million for solo GPs? She says micro funds allow moving fast with lean performance. Solo GP providing annual fundraising. She says there seems to be a trend in the US, UK now. And what's your view on fund economics for VC
So,
micro funds?
yeah. So of course I'm not an LP, right? I don't invest in funds, so I'm not an expert in this. But I will say, like what I see is that, like in maybe in the early stages, so it's Series A, there is a lot of capital available, and I think if you come in very early, it means that in Europe you have many opportunity for your portfolio company to raise more capital and increase the valuation. So I think the pass to you need to be very much more selective maybe at the beginning, but I will say that the economics are perhaps more interesting if we talk about returns at pre-seed seed, just because you have the likelihood of generating more returns and more quickly is higher if you're coming at the early stage because you have a lot of people again battling for these companies at the next stages. Now, in terms of fund economics, we talk about that, right? So we have a much less overheads. We're very careful with spending. I think it tends to be just a linear structure. So, like you have more of the dollars that are put to work for the fund. And so I think it should be more interesting. I think it's also part of the reason why you see just in those studies, like better returns for fund one, like emerging manager and micro funds.
Thank you very much for the answers, and thank you, the audience, for the questions. I would just have one closing question. for you both, Alex and Sasha. So if you could leave the audience with one lesson about building lean, being it a fund or a company, what would it be?
But on my case, like what I would want the audience to remember is that solo GP, it's not anti-institutional, it's anti-friction. I think it solves a problem in the market, whether it's in debt or in equity. So, the winners will be those who can balance, like quick, rapid decision making with institutional grade operation.
Thank you. Thank you, Alex. Sasha, what would you say?
I think that point on building lean for me is really important. Generally, when you have more money, you tend to spend more money. So it goes also with that. But when you have less money, you don't spend as much money. Like I think from my personal experience over the last 5 years, like I didn't raise from any VC funds. I initially built the business just with a redundancy check from my last company, and not being able to pay yourself a salary for like 2 years, you do tend to find creative solutions for building a business just from not having like much money. Like you won't spend on the flashy service providers, you won't spend on the expensive lawyers to help, the regulatory setup. And I think having that footing will help to build a more sustainable business in the long run. Whereas, a lot of businesses where they'll have money thrown at them from venture companies. They've spent a lot, their burn rate's high, and then in the future they'll have to make difficult decisions. Cutting staff, cutting costs, but they don't have that sustainable footing which they would have had if they actually just built lean. So that's probably my closing remarks.
Thank you. Thank you very much. This was very inspiring. I really enjoyed this conversation. I hope also our audience enjoyed this conversation. So thank you very much for joining one more Mara and Friends webinar series, and hopefully see you soon. And thank you, Alex and Sasha, for your time and for all the insights about building lean.
Yeah, thanks, Alex's, and thank you all for joining.
Thank you very much.